Welcome to the preliminary results of Hypoport for 2024. So as you are aware already, we continue our growth path, double-digit group level on all major KPIs. Core source was the real estate and mortgage market again, with a strong double-digit growth and an outperformance of the market growth. And the two smaller segments, financing platform and insurance, contributed as well on their level. So let's quick check real estate and mortgage market here in Germany. We saw during the whole year slightly lower interest rate than the previous year, pretty stable environment from the interest rate side, while consumer income significantly improved thanks to delayed increase after the strong inflation of 2022 and 2023. On the other side, on the property side, the number of properties available to buy increased on a record high level for a pretty long period. And on the other side, the supply of renting units declined. Core reason is a massive rent regulation here in Germany, which locks the renting market. Nobody with an existing renting contract is leaving the apartment anymore because of a cheap rent. So if consumers have a demand, and typically when you found a family, you get children, you need a new apartment, and there is no solution anymore in the renting market in the current situation in Germany. And more families, especially from the middle class, have to choose the property ownership now. While in the past, 58% were choosing for rent, and only 42% of Germans live in their own property. So this is a massive change in the market, which is part of the significant recovery which we see in the mortgage market. Prices in Germany started to trickle up again during the whole year, plus 5% for conduits, especially in the metropolitan areas, but as well single-family homes in the countryside slightly increased in value, so that any fear of price drops in the future left the market during 2024 as well. This led to a recovery of the market, the black line. During the year 2024, we saw a steady recovery of the market with a strong last fourth quarter, because usually fourth quarter is weaker because of the holiday season. This year, it was pretty solid numbers for the last quarter. Europace, you see the transaction volume, both inflation adjusted, both indexed, outperformed the market during 2024. And here you see a long period of 5 years in the end during the whole period. So while the market is still below everything what we saw in the last 5 years, Europace is up to the 2020 volume already again. Last year, we saw a 27% increase in transaction volume on Europace. Bundesbank reported for Germany a 21% increase in volume to 200 billion, 66 billion via Europace. So you see our relevance in the market, and as well the still incremental gains. When we look on our three major sales channels, our own franchise system with the brand Dr. Klein outperformed the total market with a growth of 30%, so plus 9% market to market. Our operations in the savings banks industry and the cooperative banking industry were even stronger, outperforming the market growth. So in both sectors, we massively increased our reach, improved our market share. So when you add this up, the three major channels, so there had to be as well a loser. One major cooperation partner of us, Deutsche Bank, was weak in 2024 whole year after a struggle in the second half of 2023 already. Here we saw a negative impact on their transaction volume, and with this an underperformance of Europace compared to the three biggest segments here in the market for us. So when we go into details and check out the use of the mortgages that we distributed, you understand a little bit better as well what is going on in the German housing market in general. While the purchase segment is back to pre-crisis level from the volume on Europace, the three other usages of mortgages are still distressed, you can say. So buying a home is the only solution right now for a lot of families to find a solution in the market and to fulfill the needs of their families. And so the numbers of properties bought by Germans trickle up now for the last 2 years and bring us to this volume. While foreigners or just investors who buy properties for rent are massively still distressed because of the unattractiveness of the renting market. So the distressed areas of our market are still new construction. You see that we are coming now to 3 billion per quarter while we were pre-crisis level of roughly 6 billion. The need is high. We need 500,000 apartments per year. Right now, we are finishing 200,000 and we are financing 150,000. So we are far under the demand side. With this, what we start in construction and finance in construction. And this mismatch is driving the prices for the upcoming periods. What is not financed right now is not built in the next 2 years. So there is a massive impact from these low numbers in new houses to the pricing side of the purchase market. Well, as well under stress is the follow-up financing, refinancing market. Here we see that the typical 10 years plus durations in the German mortgage market were lifted up to 15 years pre-crisis. And homeowners don't need to refinance right now. They can wait until 2027 when their 15 years duration fixed term period is due, and then they have to refinance. So the recovery of the refinance market we expect starting in 2027. And last, never a big topic, but should be a big topic when we look on our decarb goals here in Germany. In the next 20 years, we need to decarbonize our home ownership stock. It would need 20 billion in investments per quarter. And for now, this area is still not affected by any growth. With the change in government right now, we can just hope that there are clear signals for this area and as well new constructions here in Germany coming from the new government soon. One more view on the structure of our volume when you compare the last, we choose here 8 years, how Europe has and the market developed. You can see that we had already 8 years ago a strong position in the broker market. We expanded it slightly, but what is more important is the brokers took market share from the banks. So mortgage brokers grew, and with them, our volume is growing and giving us a constant incremental outperformance of the market. And the second major change is our success in the cooperative and the savings banks industry. Over the last 8 years, we ramped up from close to zero to now roughly 25% in both sectors with a strong growth record. Last year, if you remember 2 slides before here, we had roughly 50% growth in both sectors. So we are fast closing the gap and convincing systematically the whole sectors that we are the way to do mortgage business today, and there is no alternative to this. In total, the segment delivered strong growth, top and bottom line. When you eliminate our high investments in transitioning the property valuation business, we are at 35 billion last year with a market which is roughly on the level of 2017. So since then, we saw strong growth in the market until the crisis. We will see the strong growth again. And with this, our profits in this segment will massively uplift. Short view on the 2 other segments, financing platform. Here we service housing associations, corporate finance and the subsidiaries for them, and the personal loan business. While all 3 markets are still on the bottom and didn't recover in 2024 compared to 2023, we could deliver a small top-line growth, and thanks to a very strong cost efficiency program across the sector, we were able to provide massive profitability growth even here in this environment. And here is a massive potential for 2025 forward with a new government in place, with a positive outlook on the recovery of the German industry and consumer sentiment. We see a significant potential in the next 2 years here for an uplift to old highs back. Last unit, insurance, very stable market environment. We are digitalizing the industry here for 10 years. We are right now focused on improving our profitability level step by step while keeping a solid migration path. We are on track with this and are open for strategic partnerships, something which made us successful in the mortgage industry. And we expect that in the insurance industry, with the right partners, we can speed up this process here as well. In total, we would call it transitioning year for Hypoport. So core market is in recovery process. We are back to double-digit profitability numbers and to growth numbers, but still this is far beyond or far below this what we are able to achieve in a normal market environment here in Germany. So a long-term perspective from the gross profit, second best year ever, but with still huge investments in certain areas which reduces our EBIT level. Outlook, we expect the German housing market to fully rebound to the pre-crisis level. And this means a quarterly transaction volume of 75 to 100 billion euro. This is a massive uplift from the current level right now, even inflation adjusted. And every additional billion of transaction volume in the market, plus our market share growth, brings us higher profitability, plus our ongoing investments needs to turn into profit. Expectation for this year, we double the EBIT. We delivered a record year on the gross profit level. And with this, so have the first a pretty successful year after this crisis again. And for 2026, we expect an ongoing double-digit growth and from the perspective of probability, a new record year for Hypoport. For more details, check out the videos here on this channel or contact our IR.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.